Picture this, my friend. It was a bright Monday morning just a few weeks ago. The market was buzzing with news about a new tech company, Innovate Next, which had just launched a revolutionary battery. Everyone was talking about it. So, feeling a bit adventurous, I logged into my trading account. I did a little bit of research, maybe just a quick glance at the headlines, and decided to jump in. With a click of a button, I bought 100 shares. The price was 150 rupees per share. My heart was thumping with excitement. I was officially an investor in the future. For the first hour, it was pure magic. The stock price shot up to 155, then 158. On my screen, I could see my potential profit figure glowing in a happy green color. I was already mentally spending the money. A new telescope? A fancy trip? The possibilities seemed endless. I felt like a genius. A market wizard who had cracked the code. This trading thing was easy, I thought. But then, just as I was about to pat myself on the back, the market decided to teach me a lesson in humility. The green numbers flickered, turned risau, and on, dundee and urbainsau, scary, shade of red. The stock dipped to 148, then 145. My unrealized profit had vanished, replaced by an unrealized loss. My stomach did a little flip-flop. The joy I felt just moments ago was gone, replaced by a cold knot of anxiety. I watched the screen, glued to the little numbers as they danced up and down, jiggling between profit and loss. 1 minute I was up by a few hundred rupees, the next, I was down by 1,000. The trade was still open, my finger hovering over the sell button. I hadn't made any final move. So, it made me wonder, in that very moment, was I winning, or was I losing? This is a question every single trader on this planet asks themselves. While your position is open, and the price is fluctuating like a nervous hummingbird, what is your true state? You haven't actually gained any money, because you haven't sold the stock to lock in the profit. But you also haven't actually lost any money, because you haven't sold to realize the loss. You are stuck in a strange limbo, a state of both potential gain and potential loss, all at the same time. It's a dizzying, confusing, and frankly a very weird place to be. It's a paradox of trading. This strange state of being both a winner and a loser at the same time might sound familiar to science lovers. It reminds me of a very famous thought experiment from the world of quantum physics. Let me introduce you to a cat. But this is no ordinary cat. This is Schrödinger's cat. The idea was cooked up by a brilliant physicist named Erwin Schrödinger to explain a bizarre quantum concept. He imagined a cat placed inside a sealed, opaque box. Now stay with me, because this is where it gets wonderfully weird. It's a key idea in science. Inside that box, along with our feline friend, is a tiny bit of radioactive material. This material has a 50% chance of decaying within an hour. If it decays, it triggers a hammer that smashes a vial of poison. And, well, it's not good news for the cat. If it doesn't decay, the poison is not released, and the cat remains perfectly fine, probably purring away. The box is sealed, so we have absolutely no way of knowing what has happened inside. We cannot see it, we cannot hear it. The fate of the cat is a complete mystery to us on the outside. So, according to the strange rules of quantum mechanics, until we open the box to check, the cat is in a state of what we call superposition. This means it is considered to be both alive and dead at the exact same time. Not one or the other, but both, simultaneously. It exists in a blurry, undefined reality, a haze of all possible outcomes. The cat is a quantum ghost, a paradox locked away from our view. It's only when we interfere, when we decide to open the box, that this quantum weirdness collapses into a single, definite reality. Now, think about your open trade, the one for Innovate Next. Your stock is just like that cat in the box. As long as your trade is open, it exists in a superposition of states. It is simultaneously a profitable trade and a losing trade. The green number on your screen represents the alive cat scenario, and the red number represents the dead cat scenario. Both outcomes are possible, both are floating in the realm of potential, but neither is real just yet. Your trading account is the sealed box, and the stock's final outcome is the quantum mystery held within it. So, you're staring at your screen, watching the price of Innovate Next flicker between 152 and 147, your trade is in superposition, a state of both potential profit and potential loss. You feel the tension building up. Your heart is racing. What breaks this spell? What makes one of the outcomes real? It's your action. It's the moment you decide to click that button. In the world of quantum physics, the observer opening the box forces nature to choose an outcome for the cat. In the world of trading, you are the observer. Your decision to act is what opens the box. When you finally press the sell button, you are collapsing the superposition. You are forcing the trade to resolve into a single, definite state. If you sell when the price is at 155, you have opened the box and found an alive and very happy cat. The potential profit, which was just a flickering green number, suddenly becomes real money deposited into your account. The uncertainty is gone. You have a realized gain. You can breathe a sigh of relief knowing you made a good call. The paradox is solved, and you are officially a winner on this trade. But what if you panic? What if you see the price dip to 142 and, consumed by fear, you hit sell? In that instant, you have also opened the box, but this time, you find the tragic outcome. The potential loss, that scary red number, becomes a real concrete loss deducted from your trading capital. The superposition collapses into a realized loss. The uncertainty is over, but the result is a painful one. In both cases, selling the stock is the act of observation that ends the quantum state and makes the outcome tangible, for better or for worse. This is the most crucial moment in any trade. Until you sell, nothing is real. The paper profits or paper losses you see on your screen are just ghosts, possibilities floating in the ether. They can vanish in a heartbeat. The act of closing your position, of opening Schrödinger's box, is the only thing that converts potential into reality. It's the moment the jiggling stops and the final score is tallied. Understanding this can fundamentally change how you view your open trades. They are not wins or losses yet. They are simply unresolved questions waiting for your decision. This quantum state of uncertainty, this superposition of profit and loss, is precisely what makes trading such an intense emotional roller coaster. Our brains are not wired to handle this kind of prolonged ambiguity very well. We're, creatures who crave certainty and closure. We want to know if the cat is alive or dead. We don't like the idea of it being both. This constant flux between hope, the stock is going up, and fear, oh no, it's crashing, puts our nervous system on high alert. It can be incredibly stressful, leading to what is known as decision fatigue. This deep-seated discomfort with uncertainty is the root cause of many classic trading mistakes. One of the most common is selling too early. You have a good trade. The stock is climbing steadily, but the small, natural dips along the way fill you with anxiety. You fear that your paper profit will vanish. So, you open the box prematurely, selling for a small gain, only to watch in agony as the stock continues to soar much higher. Your fear of uncertainty made you abandon a winning position before it could truly flourish. You chose a small, certain gain over a potentially larger, uncertain one. The opposite mistake is just as damaging, refusing to sell a losing trade. This is often driven by hope, the stubborn belief that the stock must turn around. You see the red numbers getting bigger, but you can't bring yourself to take the loss. Selling would mean opening the box and confirming the cat is dead, making the loss real. So you hold on, hoping for a miracle, while the stock sinks lower and lower. This refusal to face the reality of a bad decision, this hope against all odds, can lead to catastrophic losses from which it is very difficult to recover. Both of these errors, selling winners too soon and holding losers too long, stem from the same psychological trigger, an inability to sit comfortably with uncertainty. We either grab a small profit to escape the anxiety of losing it, or we avoid a small loss to escape the pain of admitting we were wrong. In both scenarios, our emotions are a direct reaction to the Schrödinger-like state of our open trade. We are not making rational decisions based on a plan. We're making emotional decisions to escape the discomfort of the unknown quantum state. So, if we are all trapped in this quantum paradox when we trade, how can we survive and even thrive? How do we tame this beast of uncertainty? The answer is not to eliminate uncertainty. That's impossible. It's part of the very fabric of the markets, just as it is in quantum physics. The answer is to learn how to manage it with a clear head. The first step is acceptance. You must accept that while a trade is open, you are in a state of superposition. The outcome is not yet determined. This mental shift can help you detach emotionally from the flickering numbers on the screen. The most powerful tool for managing uncertainty is to have a plan before you ever enter the trade. Before you click buy, you must decide your rules for opening the box. This means setting a clear target price where you will sell for a profit. This is your alive cat plan. Equally important, you must set a stop-loss price, a point at which you will sell to cut your losses, your dead cat plan. This pre-planning removes the emotional guesswork from the equation. You are no longer deciding in a moment of panic or greed, you're simply executing a decision you made when you were calm and rational. Another critical rule is to manage your position size. The stress of uncertainty grows exponentially with the amount of money at stake. If you bet the farm on a single trade, every tiny price movement will feel like a life or death situation. You will be too emotional to stick to your plan. The golden rule is simple: never invest more money in a single trade than you can afford to lose without it seriously impacting your life. By keeping your bets small, you reduce the emotional stakes. This allows you to view the outcome with scientific detachment rather than gut-wrenching fear. Ultimately, embracing uncertainty is the key to becoming a more rational and less stressed trader. Think of yourself as a scientist running an experiment. You form a hypothesis: this stock will go up. You set your parameters, your entry, profit target, and stop loss, and then you let the experiment run. You don't get angry at the experiment if it fails. You simply note the result and learn from it. By setting rules, managing risk, and accepting the quantum nature of trading, you can step back from the emotional roller coaster and make clearer, smarter decisions. You can finally learn to be comfortable with the cat in the box.